Good morning, everyone. This is Ravi Kant. I shall read out a brief disclaimer for today's call. The discussion on today's call regarding CGCL's earnings performance will be based on judgments derived from the declared results and information regarding the business opportunity available to the company at this time. The company's performance is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially in future. Given these uncertainties and other factors, participants on today's call may observe due caution while interpreting the results. The full disclaimer is available on slide 43 of Q2 FY24 investor deck. Participants are requested to note the same. And I request our MD, Mr. Rajesh Sharma, to present the opening remarks.
Good afternoon, friends, and season's greetings to all on the call. We declared our reviewed consolidated results for Q2 FY24 on Tuesday, 31st October 2023. I hope you had a chance to go through the investor deck. In our discussion post Q1 FY24 earnings, we stated we had made a sound start to FY24 with a healthy business and earning momentum. I shall revisit some of the discussions of the business in Q1 FY24 and also provide a perspective on our Q2 FY24 earnings. Please refer slides 4, 5 and 6. After a lean Q1 FY24, our disbursal momentum picked up in a strong manner in Q2 FY24. Disbursals increased 130% year-on-year and 31% on quarter-on-quarter to 35.3 billion rupees. Disbursal momentum was dominated by gold and housing business, which contributed 66% of incremental disbursals. MSME picked up pace, increasing 12% quarter-on-quarter to rupees 3.7 billion. Excluding gold loans, our disbursal increased 35% year-on-year. Construction finance maintained pace, although the disbursal were unchanged year-on-year at rupees 4.1 billion. The AUM momentum continued to be robust, increasing 59% year-on-year to rupees 123.6 billion in Q2 FY24. AUM excluding gold loans increased 35% year-on-year and 7% quarter-on-quarter. Share of gold loans continued to increase, rising to 16% of AUM compared to 14% in Q1 FY24 and 2% in Q2 FY23. We expect our gold loan AUM to touch or cross rupees 30 billion by the end of this year, which could be 20% of AUM, assuming we sustain a 50% momentum in overall AUM growth. Our AUM includes a co-lending AUM of rupees 9.7 billion, which is up 4x year-on-year and 40% quarter-on-quarter and constitute 8% of AUM. We started co-lending under gold loans during Q2 FY24 and currently have tie-up with 2 commercial banks. On slide 5, we have introduced new charts to show the journey of our co-lending business across MSME, housing and gold loan segments. We have reported a 16% year-on-year and 3% quarter-on-quarter increase in our net profits to 652 million. To fully understand the earnings, let me first start the core earnings. Our net interest income increased 63% year-on-year and 5% quarter-on-quarter to rupees 2,493 million. The quarter-on-quarter growth momentum of net interest income was softer owing to spread movement. Our weighted average yield on advances declined 13 basis quarter-on-quarter to 15.58 in Q2 FY24 from 15.7 in Q1 FY24, while the cost of fund increased 21 basis quarter-on-quarter to 8.93. The increase in cost of funds was in line with the increase in MCLR-linked commercial bank borrowings that constitute 87% of our borrowing. This led to a spread compression, as highlighted in slide 17. While our consolidated cost of borrowing is competitive, given the overall pass-through that are happening in the cost of money across the banking system, we expect our cost of borrowing to also go up some more during H2 FY24. Some of the cost increase is expected to be compensated by an improving mix of higher yielding loans. The share of our non-interest income in net income declined to 24.3% from 25% marginally. Q1 FY primarily on account of some changing dynamics in the car loan business. However, the car fee income and co-lending income picked up in line with the growth in lending business, increasing 22% quarter-on-quarter and 86% year-on-year. Although car loan origination are up on the path to cross 10,000 crore total origination during FY24, net fee income is expected to be soft due to intense competition. We will continue to gain market share in the origination market. The cost-to-income ratio slightly increased to 66.9% from 66% from Q1 to Q2. The cost-to-income ratio excluding gold loan business was 51%, broadly stable quarter-on-quarter. The adjusted cost-to-income ratio is marginally higher than 48% reported in FY24. As we have been stating, the cost-to-income ratio should improve as we expect earnings to pick up faster relative to operating expenses during H2 FY24. Our gold loan network touched 742 branches on September 30, 2023. We had possession of few more branches which were yet to go live. With that, we have reached the initial target of 750 gold loan branches for H1 FY24. We shall be pausing the branch addition in gold loan business in H2 FY24. As stated earlier, we expect this to add to improving our cost-income ratio to H2 FY24. Our GNPA ratio stood at 1.93%, 4 bps higher than Q1 FY24, but substantially lower than 2.36% ratio we reported in Q2 FY23. The PCR on stage 3 assets improved to 32.3%, primarily on account of proactive provisioning. We are inclined to improve the PCR further. Our credit cost stood at rupees 239 million, which was higher than rupees 112 million in Q4 FY23, but marginally lower than rupees 246 million reported in Q1 FY23. As highlighted on slide 13, the average credit cost in trailing 5 quarters is 176 million. During Q1 FY24, we made some accelerated provisioning on 3 construction finance exposure to a single entity amounting to 160 million rupees. This was restructured and classified as NPA, attracting a provision rupees 50 million or 31% of exposure. We have further increased the provisioning on same, taking the provision coverage ratio to 87% on construction finance and indirect lending portfolio. Recovery efforts are underway, and like past instances, we are confident of fully recovering the outstanding amounts. Our credit cost to average AUM ratio was 78 bps annualized in Q2 FY24 compared to 89 bps in Q1 FY24. This is in line with our pre-COVID long-term trend. We have reported 2.1% ROA and 7.1% ROE in Q2 FY24. Excluding the losses in the gold loan business, our ROA and ROE would have been 2.8% and 9.5% respectively. As we move towards the break-even in gold loan business, our profitability should substantially increase, especially in H2 FY24. There shall also be additional drivers like the absence of one-off adjustment that shall contribute to the profit momentum. To conclude, I would say we remain on a path of a strong growth and profitability in H2 FY24. With that, I conclude my remarks. We shall now take questions.
Thank you, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question on your touchtone phones. Participants, you may press star and 1 to ask a question. We would like to remind the participants to press star and 1 on their touchtone phone to join the question queue. We will wait for the question queue to assemble. The first question is from the line of Mr. Bunty Chawla from IDBI Capital. Please go ahead, sir.
Yeah, thank you, sir. Thank you very much. In the opening commentary, you said that there has been a pressure on the spreads or on the yields due to the competitive pressure. So can you elaborate which segment we have more pressure for? Is it MSME, is it gold, or is it housing? And so going forward, what will be the sustainable yields for these segments going forward, and what will be the cost of funds similarly?
So if we see overall basis, our yield on advances was 15.7 in Q1 FY24, which has come down to 15.6, and thereby resulting in a spread compression of 40 basis from 7% to 6.6, primarily because of construction finance portfolio has been, a lot of construction finance portfolio has been prepaid, and the new loan are happening at the lower rate of interest. So there we have seen that because of the faster sale of the inventory on those accounts, there is a faster prepayment and repayment, and thereby the new portfolio, because of the competition, is happening at lower rate of interest. And there we have seen that our spread have come down. But in coming S2 24, we believe that gold loan share will go up in overall portfolio. That will improve the overall yield on the advances. And we also feel that our cost of funds, which is another factor, which have gone up by 21 basis, we should be able to pass on in the incremental lending better. So that should improve our overall the spreads.
Mr. Bunty?
Yeah, so can we say the 6.6% spread which you have reported in Q2 should be sustainable for second half of the year?
6.6 definitely sustainable. We still expect this to slightly better because our current AUM of 2,000 crore gold loan will become the 3,000 crore. Gold loan AUM should give us, increase the change in the mix, because that is the highest yield product in our overall portfolio. And gold loan, if it increase to 3,000 crore rupees, that mix will also improve the overall yield on the advance.
So as you read, it's purely on the construction finance we have got the impact on the yield. Going and no more in gold loan or housing, we don't have any competitive pressure, right?
Suppose we remove the gold construction finance portfolio from this calculation, then our yield would have become better by 3 basis.
Okay. So similarly, can you share your thought process on the cost of funds going forward, sir?
So cost of fund, I think cost of fund largely a market driven. So unless there is a change in the credit rating of the company. We will continue to be in the same bracket of the cost of fund, but certain MCLR of the old loan are going to reset. So there we'll see another some basis to cost of fund to go up, but that will not be more than 10 basis. And however, we are able to pass on this increased cost of fund to our all incremental lending.
Secondly, sir, there has been a high credit cost. You rightly said that because we have taken a proactive step in increasing the provisioning. So, but sir, if you see the provisioning, it's kind of a 32%. How much we are targeting to increase this PCR level? Because what we have observed in other large, or you can say large size NBFCs, they have a PCR on stage 3 is approximately 40% plus kind of a thing. Some have 45, some have 40, some are 50. So where we are targeting to reach our PCR and how this will impact the credit cost going forward for us?
So we will gradual manner, we will increase this PCR in line with what I think market expect and in line with the best practices. But if you look at our portfolio is little differentiated from many other who have a higher, because our portfolio is completely collateralized either by the gold or by the self-occupied house or by the self-occupied business premises. However, with a conservative approach, if you see the PCR, last quarter it was 27.8. Now it has gone to 32.2. Already 448 basis PCR has been increased and gradually will increase. We don't want to give a level at the moment, but we will keep increasing it quarter on quarter and stabilize somewhere about 37 to 40%.
Okay, sir. So lastly, on the gold loan, as you have shared that almost 750 branches we have touched. So no more increased branches in a shorter period of time. So how one should see the gold loan growth going forward? Because until now, the branch increase was supporting higher gold loan growth. So how we should see the gold loan growth going forward?
So gold loan business, as I said, from current AUM about 2,000 crore, March we expected to close about 3,000 crore rupees. And by then our all branches which are contributing the losses because they were in the investment phase, and so now I think most of the branches will achieve the break-even and they will start contributing to profitability also in the last quarter. So next year again we will draw a plan to add some more branches. That plan is not yet firmed up, okay, how many branches and where we will be opening. So we'll deliberate that somewhat in the next quarter and then we'll implement in the first quarter of the new financial year.
Sir, so can you share the ballpark gold loan growth, AUM growth for next 2 to 3 years, how it should shape out? Ballpark number, roughly.
Ballpark number, you can imagine from 3,000 crore, we should able to reach almost 30-35% growth for next 2 years, even though we don't open the branch, but we are going to add the branch. As I said, we are not, but definitely 30 to 35% growth we are going to achieve.
Okay, sir. That was very helpful, sir. Thank you very much.
Thank you. The next question is from the line of Mr. Priyesh Jain from HSBC. Please go ahead, sir.
Thank you. So we are noticing that there is a steady increase in the co-lending share. I have some questions regarding that. I want to understand, is the customer profile under co-lending, how different is the customer profile under the co-lending book versus the on-book loans? If you could throw some light on that.
So under the co-lending, we are doing MSME, home loan and the gold loan. When we do the loan basis as if we are going to keep in our book. Thereafter, we run our data science teams made program where we say which bank qualify for which pool, and accordingly we give those pools to those banks. But there is no specific program we carry out under co-lending. It is our product policy, and that is what the same is adopted by the bank also. So there is no specific origination or underwriting is done targeting it. This we should go in co-lending. In routine course, our portfolio, whatever gets qualified, we place under the co-lending.
Fair enough, sir. So I'm just trying to understand, I'm trying to get a flavor of the co-lending book versus the regular book. So maybe if you could, what I understand is there are no any specific products being made or co-created specifically for such co-lending partners, but there might be some filters, and ultimately the book that they get is different. What is the differences between that book and our book? Maybe there could be any differences in the loan characteristic or something, in terms of interest rates or ticket size or tenure or things like that.
No. So it is like this. When we sign the co-lending partnership, our product is aligned first, and within that they keep a criteria. Suppose some banks say, I will take the CIBIL score of 750. Somebody will say 700. Somebody will say loan to value, I will give 75%. Somebody will say, I will give 80%. So these are the variations every bank have like that. And within that, but we have our own policy. So our portfolio meet their criteria. Whatever the pool and the specific loan account meet the criteria, those are placed under co-lending. But when we onboard the customer agent, we have to underwrite and we have to collect it back. So that underwriter and branch doesn't know whom to originate, whether for co-lending or not. It is happening after the customer is onboarded, and then we put the filter, and accordingly we show it to our partner banks.
Okay. All right. Okay. Thank you, sir. That was helpful. Those are my questions.
Thank you. The next question is from the line of Mr. Jay from IIFL Securities. Please go ahead, sir.
Hello. Yeah, am I audible?
Yes, please.
Yes, sir.
Yeah. Our co-lending contribution has increased consistently over past few quarters. And so what could be the sustainable level here in each business segment of SME, housing finance, and gold finance? And what will be the incremental focus in this amongst this business segment for co-lending?
Sir, could you speak a little bit louder and request you to please repeat your question?
Yeah, our co-lending contribution has increased over past few quarters, and so what could be our sustainable level here? And incrementally, on which segment we could be focusing more? Will it be MSME or housing finance?
So co-lending partnership we have across MSME, home loan and gold loan. And we feel that co-lending under the gold loan will increase as compared to the two other products. The growth is happening in the gold loan. So there substantial co-lending is expected to happen. We expect that out of 3,000 crore, at least 20% book will go under the co-lending. That is the target we are chasing. Of course, it depends also on the banks to grant the facilities and all, but we are hopeful to achieve that. MSME and the home loan put together are happening month on month on a regular basis, and I think that is happening at the pace of 40 to 50 crore a month. And with that pace, that will continue. However, sometime even we also pace up based on our pricing, our overall contribution basis. So sometimes we slow it down, sometimes we increase it basis what pricing criteria we are getting from the partner banks.
Got it. Yeah, that was helpful, sir. Thank you.
Thank you. Before we take the next question, we would like to remind the participants that you may press star and 1 to ask a question. The next question is from the line of Mr. Anuj Mohta from Equirus Securities Private Limited. Please go ahead, sir.
Hi, sir. Am I audible?
Yes, sir, you're audible.
Yeah. So good. Congratulations for good set of numbers. So I just wanted to ask, like you have highlighted in your opening remarks that H2 will be better in terms of disbursement and all this. But given that our share, like our portfolio mix is more focused towards rural and semi-urban area, and there we are seeing some challenges due to rising inflation. So how do you see the demand pending up in this H2, and how it will affect our disbursement going forward?
So I think the way we are saying there is no lack or slowing down of the demand in tier 2, tier 3 town where our MSME home loan and gold loans are happening. We clearly see that there is adequate demand at a particular level, and we hope to see that Q2 will be as traditional happening for all lending businesses. We say this year also we expect our H2 to be much higher in terms of volume, in terms of better contribution, because there is adequate demand on the ground. So we are not seeing any slowing down of the demand of the loan.
Okay. Thank you so much.
Thank you. The next question is from the line of Mr. Satya Prakash from Haitong Securities Private Limited. Please go ahead, sir.
Hi, am I audible?
Yes, sir, you are.
Yeah. Hi, sir. Congratulations for the good set of number. My question is, the new subsidiary that we have incorporated, Capri Loan Car Platform, would all the car loan business going to be carried from this? And are we planning to list this business separately? Any specific reason for that? Hello?
Since that business is now getting to a size where we are going to already done about 4,500 crore number, and I think this year we will do about 10,000 crore number is it looks like, and our target is. So in 10,000 crore, we will be doing about 80,000 plus car finance through our network. And this business requires a separate thrust on the technology side, and we have a couple of other plans in that business. So we believe that this distribution piece of the car loan should be separate. On back of the car loan distribution, we are also now started selling the insurance to those customers. Mm-hmm. So to bring that separate thrust, supervisory and separate profitability, we have taken that from the new company, where all the empanelment and the partnership with the banks will be shifted, while economic interest at consolidated level comes to the company, but there will be separate business head, separate head of the acquisition, network, and technology cars separate. There will be CTO and data science team. They will be, so I think to bring more focus on that business and to build the distribution around that, the separate SP have been carved out. And you will see that next year there will be enhanced effort on building that brand separately.
Okay. So one more question, if I may ask. That is that even if we adjust for the gold loan business, our cost to income is almost at 50%, as mentioned in the presentation. Also, it is majorly attributed to the increased digital spending. Any other reason when can we expect this to normalize? Would we see it going in range of 35 to 40% in near future?
So there's a lot of spending happening on the technology team. We have about 125 people team in the technology and data science. Mm-hmm. So for that result will also, once our new technology platform is launched in the target date is April 2024. And there will be some more addition to that which will complete in next 3 to 6 months. So by September, our technology piece should be by and large up and running in a full force with the revised mortgage tech and the property tech and everything. With that, there will be two impacts. One is the productivity of the team will improve. So the same amount of people will be able to disburse higher. thereby increasing the overall contribution. And two, there will be lesser spending going forward after September 2024 on the technology side. So overall efficiency will improve and also cost will come down. So that should bring our cost-income ratio down. Now, cost-income ratio will come down to 45% or 40%. I think that I'm not able to comment yet. But definitely next year you will see remarkable difference in the cost-income ratio.
Okay, sir. Thank you so much. Those were my questions. Good luck. Thank you.
Thank you. Participants who wish to ask questions may press star and 1. We will wait for a moment for the question queue to assemble. As there are no further questions, I would now like to hand over the conference to the management for closing comments.
Yes, thank you. So, as stated during the call and the Q&A session, we'll continue to build our distribution through branches. We have already now 870 branches are up and running. And we have also focused on distributing insurance product and car loan distribution, which will enhance our fee income, which will support our ROE. Our gold loan branches will start contributing from the last quarter onwards, and there will be substantial profitability coming in the next year onwards. So we are quite hopeful that with the launch of our new technology initiative, new loan origin system, and Oracle FlexCube being a LMS system fully operational by March 2024. All these initially put together a low cost income ratio and a very high growth. As you have seen, we are growing at the pace of about 50% on AUM basis. That growth coupled with the lower cost income ratio and better tech initiative, company is on the path to achieve better profitability. And our asset quality on overall basis is still in very control. We are in a collateralized lending portfolio. We clearly see that when economy is growing, there's a clear demand is happening on ground, and we should reap the benefit of our branch network to build a quality, profitable portfolio along the way. Thank you so much.